investor ready plans and lender ready plans. So for those of you who have joined previous webinars, we have discussed what a lender ready business plan looks like, and actually had one of our on that webinar to discuss what do banks look for. But when we're looking at an investor focused plan, there are some key areas where there is a difference. And so first is on that goal and audience focus. So an investor plan is essentially a story about growth and return on investment. You want to highlight how the investor's capital will fuel significant expansion and increase the company's valuation. Whereas for a lender ready plan, let's say like for an SBA loan or for a bank loan, they're looking more for stability and risk mitigation, because for a lender, you're repaying a loan. So while the investor plan sells vision and upside potential, the lender plan sells predictability and security, essentially de-risked as much as possible on that lender side. The next piece is on that upside versus downside. So investors are generally willing to take more risk for a higher reward, and Chad will talk about all of this in more detail, but they're looking for the upside. So what's that market opportunity? Do you have that scalable model? And what does that potential for high returns looks like? So you want to be pointing out in specific pieces such as the target market, your competitive advantage, and how you plan ensuring a significant amount of the market. Whereas lenders, they basically want to understand, okay, what is absolute worst case scenario, and what is your risk mitigation to that, and how can I guarantee that you won't default on your payments. Next is in the level of detail and the length of the actual business plan or of the actual deliverables. And so for an investor ready plan, it tends to be more lean, more high level on the narrative side than for that internal operational plan or that lender focused plan. So investors will typically first read the executive summary or the pitch deck, more likely than not the pitch deck. But your plan should be concise and compelling on that investor side, focusing on strategic points and proof of potential. Whereas a lender plan is more extensive. They want to understand how are you going to operate down to those different details. And for those of you who aren't going for a bank loan, this could also just be framed as what's your internal operational plan, what's your internal foundational plan. You want to really kind of pull that up for investors and understand where is that compelling story, and how do we get this ready for investors to basically say yay or nay to what we are trying to do. Next is on that financial projections and traction. So this is a big one. As I kind of hinted at, the narrative piece for the story for investors is really important, but those operational details are important for lenders. On the financial side, in the investor plan, your financial projections will likely be aggressive. You want to show ambition in the revenue, users, and other key metrics. But they also want to see the scalability and the upside that your business could achieve with their funding. They also, just from experience, they are looking for very, very detailed projections on both the lender side and the investor side. They are looking for that granular level. We have gotten actually feedback from clients before where investors are looking down to the equation and the understanding of how did you actually get to those numbers. And so in a typical lender-oriented plan, those projections are more realistic, they're more conservative, and traction is typically seen as more historical and steady over time. On the investor side, due to the structure of the business and the type of business, you could see more so that explosive growth. But as I said at the beginning, I know everyone is joining from around the world, and the economy kind of just globally right now is all over the place. And so for those financial projections, Chad, can you actually talk about what you're seeing in the VC world? Like, are investors wanting to see more conservative projections now, or is that thought process of that aggressive growth, does that still hold true?
Yeah, so I think that something that's been a running theme in the industry for the past few years is that the super aggressive business plans to think that they're going to scale and grow, significantly is potentially a thing of the past. I think people want to see these models rooted in truth and realism, and say we're going to take austerity measures to make sure that we grow this business efficiently and fiduciary way, and where investor capital is getting used for necessary business expenses rather than scaling for growth as quickly as possible. And so I think that that's just a broader macroeconomic factor of the past few venture cycles have led to a bunch of really, really high valuation increases really quickly that aren't substantiated by the underlying business model. And so I think that investors today are taking a step back and taking a more relaxed approach and want to see businesses built the right way, even if they're scaling for venture type growth.
Yep. That makes a lot. And for those of you, also on the call, so with how many changes, we see in the market, and how quickly things change, how, investor expectations can change. What we actually do here on the service team is Chad actually reviews all documentation before it goes out to really, help us keep that pulse on the market and help ensure that we are setting up the deliverables so that that you are put in the best light possible. So he really helps us keep understanding of the changes, and also just making sure that the deliverables do the same. So thank you, Chad. And then last but not least is the risk and opportunity framing. So in that investor plan, kind of what just Chad was just talking about, you don't want to shy away from discussing risks, but there are more so opportunities. And how are you going to overcome those different risks? Investors know probably more so than anybody that startups have risk, and they want to see that you know what your risks are and you have the strategies to manage them. This really helps build that trust because investors, yes, they're investing in the business, they're investing in the potential, they're investing in your vision, but the key piece of all of those different moving parts is you, the founder, and that is who investors are investing in at the very end of the day. And so you want to build that trust. But yeah, so in summary, investor plan is more so that bold vision backed by evidence and traction, with a clear ask for funding that's going to unlock growth. As Chad just said, leaning more towards conservative, whereas the lender ready or that internal operational plan is that detailed roadmap that really kind of sets the foundation of, how are you going to grow? What's all your plans? And showing that you can run the business prudently and meet financial obligations.